We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the Cash Flow Pro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of Cash Flow Pro, your daily real estate investing podcast and YouTube channel. I'm here today with Brian Burke of Praxis Capital. Brian, how are you today?
I'm doing great, Casey. How about you?
Awesome, man. Doing wonderful, other than it is hot outside. As of recording, it's like 106 or 7 heat index with like 80 or 90% humidity. So life is hot, but life is good.
Awesome. Well, I'd almost be willing to trade places with you. I don't mind the heat.
Yeah, they always said it's not the heat that'll get you; it's the humidity. And I'm the older I get, the firmer I believe in that for sure. So
makes sense.
So, hey, Brian, why don't you tell us a little bit about yourself and where you come from and how you got where you're going, and then we'll kind of dive in and go into some capital raising and stuff like that.
Yeah, well, you probably invited me onto this show because I'm in the real estate investment business, and that's what this is all about, right? It's all about real estate investing, and that's about the only thing I know how to do. I've been doing this for 33 years now. I started out in single family homes and, buying, fixing up, and reselling single family houses, the fix and flip strategy, so to speak. And then about 20 years ago, I got into multifamily when I did a personal 1031 investment and never looked back. I mean, it's been a major part of our business ever since. And I would say in the last probably 12, 13 years, it's been a major part of our business. And now it's really our only focus is multifamily. We've bought about 4,000 units throughout the years, and just getting close to about $1 billion in real estate acquired, which is a statement I never would have thought I would have been able to say when I first got into this business when I was 20 years old.
Yeah, man. I mean, that's definitely moving on up. I mean, that's where some of us that are a little younger and newer in the business, obviously, that's something we hope we can say someday. But man, it's definitely a tough business. And again, as of this recording, I mean, the interest rates are starting to tick up a little bit, and the climate is really starting to change. And whether it's going to be good or bad, I don't, is still yet to be determined. But nevertheless, some changes in the air. And I think we're going to start at least seeing a little loosening up of the cap rates, wouldn't you think?
Yeah, I think we're already starting to see that. We've cap rates have been compressing for how long now?
Yeah,
at least 10 years. Cap rates have been compressing.
Yeah,
and for 10 years I've been saying like this is going to stop. It's not going to keep doing this forever. And for 10 years I've been wrong. And I guess even a broken clock is right twice, right?
Right.
And so finally here we are, and cap rates are beginning to decompress to an extent, which is long overdue in my opinion. But we're starting to see that, and I think really we're seeing the most of that happening over the course of the last 8 to 12 weeks, depending on when this aired. Let's use months, so we're probably talking about April through June of 2022 has been the period when I began to see that cap rate decompression.
Yeah. And, and it always seemed like every time real estate would come down, it would eventually get to a broker's hands. It's like, once it got to the broker's hands, that's like when it immediately compressed, like as far as it possibly could, which we all know why. I mean, it's not a huge secret that the broker's working for the seller and trying to get them the most amount of money possible. But at the same time, it's still, man, I don't know. Some of these things, it just doesn't, I can't imagine they're going to come out of them when they come full cycle, that they're going to be just super, super profitable. I don't know. I could be wrong. I hope I'm wrong. I hope the thing just keeps going and going and going, but I just don't know. Um, and I mentioned it on this show several times, and I'm sure my audience gets tired of hearing it, but the, back, we're not that far separated from the times when big canvas signs were draped over the side of some of these apartment buildings saying free plasma screen TV with the signing
Right.
of a 1-year lease, And so,
Right. 2
people in
months
the
free
value,
rent.
yeah, or free, whatever, just some type of a lead magnet of some kind. And so, you know, I've been, I've been very hesitant in some of the questions that I've answered myself, and I want you to kind of maybe take this too and talk about it a little bit. But when the raising of rents is like, I'm going to say over 60% of the strategy for increase in value or total turnaround value. I just, man, that's, you got to almost be just super, super hesitant of that, because that's like the first thing that goes. You add a hard asset to an asset, you at least have something, right? Or what's your thoughts on that?
Well, starting at the beginning of your comments, your remarks there, it's easy to blame the brokers for cap rate compression and increasing prices in an increasing price environment, because you say, well, they're trying to get the sellers the most money, but really who was to blame was the buyers, because the buyers were paying it, and brokers are going to push the price as far as they can and still get offers. And I know we were selling a lot of stuff. I've sold about 2,500 units in the last year and a half, and in a year ago we were getting 15 to 20 offers per property that we would put out to market, and buyers were climbing over one another to pay the highest price.
Sure.
Now we're starting to see cap rates loosen a little bit, and now is when I blame the brokers for having some difficulty, right? Because
Yep.
Prices need to fall a little bit. Interest rates are up. Rent growth is going to begin to slow down, so pricing has to react to that. And brokers want to get the listing, so therefore they have to set seller expectations. They tend to set seller expectations a little bit on the high side sometimes, and not all brokers are in this category. Some don't do this, but some do. And when they tell the seller, well, you can get $300,000 a unit for this property, the seller is forever married to that number. And now when reality for that same property is probably $250,000 a door, getting them to come off of that 300 number is difficult. So now we're in this difficult standoff where sellers want a higher number, buyers aren't willing to pay it, and therefore as a result things aren't trading. You have deals falling apart, you have stuff that's being listed that's lingering and not getting offers. When they do get offers, they're not getting many. And that's because buyers are cautious, and buyers are cautious for a good reason. And that comes to the last part of your remarks that you just made, is that rent growth has been there for those buyers. And you could have bought something 3 years ago and you're getting 15 to 20% annual rent growth. Even if you paid too much, you still look like a hero, and you got a great deal and whatever. But now you're starting to find there's limits to how much people can pay. And when this kind of first started getting kicked off, you would see people getting substantial wage increases, and they could afford to pay 20% more in rent and still have more disposable income than they had before their wage increase. But now you have other competing expenses for those wage increase dollars. You've got gas prices at $6 a gallon. I'm in California. I just saw $7 the other day.
Yeah.
You've got food prices that are going up. You got, other raw material prices that are going up, regular consumer goods, appliances, everything is on the rise, and they're all competing for that wage increase dollar. And therefore there's less to go around to support continued rent increases. So the question in my mind always comes down to, when is that music going to stop? And, when are you going to see rent increases begin to mitigate? Because that's going to drive cap rates up even further if that happens.
Yeah. And you know, the single family business is still is much the same. I mean, and everything you're seeing on almost every local level is now, you know, you're still getting offers, but like you said, you go from buyers clamoring over one another and trying to outwit everybody else to now you get a few offers, and it's just almost like you said, a standoff, I guess, really, because now the buyer's expectations are here, the reality is here, and then your buyers fall somewhere in the middle, and so it's really just, I don't know, man. It's going to be an interesting run here. I think, I think, and I've had this discussion on the broker side of things with clients where they're like, I had a guy that like just flat out threw a fit because he was going to get a 4% interest rate. They couldn't get him the 3.5 they could have got him 2 weeks ago or whatever it was, and it was just like I was like, man, dude, when I started in this business, I mean, we were like 6-7%. I mean, you're like gonna take this deal out back and shoot it because you can't get a 3.5, you have to get a 4. And it's just like, I don't know, man. It's like the human psyche forgets all of this stuff that we've all seen numerous times and we've all gone through numerous times. And I don't know, man, the winds are changing. So
Well, there's a concept in called the 5 stages of grief, right? And so, like, when there's a death in the family, you go through the 5 stages of grief, and usually the first stage is denial. Like,
yeah,
there's no way that person is gone. And we have to go through, and then for the last stage is acceptance. Okay,
yeah,
they're gone. I have to move on with my life now. Well, to get from there's no way they died to I'm going to live without them is a long road to hoe. And this
yep,
is the same thing. You have to go through these same 5 stages of grief. There's no way interest rates could be this high. I'm not paying that. And then
yep.
eventually it's like, okay, well, if I'm going to invest in real estate, I'm going to have to, play by today's rules.
Yeah,
Uh,
yeah, and some of the churning of some of these properties as well is gonna. I don't know. At some point, I feel like that could potentially catch up because at some point, or do you think the REITs take over after, or the long term folks take over after a certain amount of time? Because it seems like you have these syndicators that are stepping in, they're buying a property, they're increasing rents, they're doing value add, they're adding assets to the asset, and then they've got a 5-year cycle, and eventually, I mean, somebody's going to that 5-year cycle at some point is going to trip, and they're not going to want to take. So obviously, we have things built into the PPM and all that other stuff, right? In order to kind of soften that, say, hey, we can have a 1-year extension, 2 1-year extensions, or whatever. And so some of that's going to be a little bit. I mean, I just don't know. It's just the cycles are going to really just start to, I guess, show what they're made of, I guess, is the way I feel.
well, yeah, it's we were buying stuff, 3 or 4 years ago with 5 to 7 year hold business plans. We're going to renovate and do all these things, increase revenue, and then sell in 5 to 7 years. And then lo and behold, we don't do a thing, and rents still go up 50%, and we sell and hit our 10-year price projection in 18 months. So those days are over. We saw that happen, and we capitalized on that and had a lot of really short, quick turns. We're selling 2 deals now. We've owned only a year and a half, and we're selling them for almost double the price.
Yeah.
But that's not you can't buy today and do that right now. If you're going to hold this thing for 5 years on a 5 to 7 year business plan, and you might even end up holding it for 10, depending upon whether or not there's any kind of trough that you have to ride through before you start to see that appreciation coming through.
Yeah, and this is, and again, I mentioned this many times on this podcast and on other podcasts, and looking at things in the micro, and I'm talking about the micro stage of like a 5-year stage, right? That to me is micro when you're looking at at a graph of, say, the last 100 years. And you go back to 2006, man, there was never going to be another bad day. I mean, everybody was just gun ho. Everybody was bad. I mean, it was just strong, and we were rolling. There was never going to be another bad day. And then all of a sudden, not only was it a bad day, but it was the worst day, right? And everybody was like, okay, the end is here. The end of life as we know it is here. And then 3 years, and then now here we are, 15 years separated from '07, 14 years separated from '08. And I don't know that there's not a single piece of property that I wouldn't buy right now, almost sight unseen, at a 2006 price, which was supposedly the highest that it ever was. I mean, so these trip ups happen. It just always seems to deflate people when they do, and it takes a lot of, I guess, I don't know what the word I'm trying to look like. It takes a lot of cinnamon out of the market. It takes that human element and really exacerbates it, and the reflection that people start to do on where they just came from. And I guess I'm talking too on a little bit of the consumer side more probably than the commercial side, but I think it has to emulate one another.
It does. I mean, there's probably, people that are in their 30s right now who would never want to own a home because they, saw what their parents went through in 2007 and 8 and lost a ton of money on the house and said, well, real estate's a losing game. And if their parents could have held on, they would actually have a house worth more now than it was when they bought it at the peak. Right? Yeah. So, that's just the way this business is. It deflates people, and that's just part of the natural progression of the human nature, right? Everybody wants to jump in when things are going great, but actually the best time to jump in is when everybody else is, just running for the exits.
That's right. And I think and then when they start running for the exits, that's where your deals are made, and that's where things really kind of come to fruition. As far as like that's where you can pick up some of the things where the people that were emotionally in it now are emotionally out, and now you can go in and be like, pick that out. Now the people that are pure numbers guys like us, that I'm gonna sit down and dissect the numbers no matter what the news says or what's going on. The numbers have to work in order to work for the investors. And so, but anyway, so tell us a little bit about, Praxis Capital. I'd like to learn a little bit more about your business and what you do, and specifically what your roles are, and how all of that kind of came to be.
Yeah, I mean, our business is really like a lighter value add multifamily model, and we've transitioned a little bit here in recent years. We used to buy a lot of like B- to C properties. We've upscaled to like A- to B+ is really our sweet spot right now. Value add to us is light interior upgrades that can improve the desirability of apartment units for our residents, and that's really all we're focused on right now. And we've sure. We built up this portfolio to around 4,000 units. Then we started selling, and we've sold almost everything we own. We now we got 2 more properties that are closing escrow here in a couple months. I feel like we sold just right at the peak. And then that'll leave us with about 750 units or so that we acquired mid to late last year. And we'll probably hold those for a number of years, because I imagine it's going to take a while for us to see the kind of gains that we've realized over the last couple of years.
And you can, if you've sold and have stuffed back enough and have a decent, and have some investors that have a palate for a little bit of risk. I mean, just the cash, I don't know. I think that if you've sold out of the real property, you've escaped at least the peak of the inflationary period, and you can kind of maybe ride that back out, because everybody talks about inflation costing you money, but if you trade it out and you have the cash now and it starts to come back down, that cash increases in value. It's just like what we used to say in the commodities market. We used to trade commodities. As a matter of fact, my Series 3 license when I first got out of college, and we every time there was a winner, there was also a loser. Every time there was a loser, there was also a winner. And so when you're flipping out of things like that, and you can stomach a little risk on those other units, and hey, ride out a trough and then come out on the other side higher than you were this time.
Yeah, and I think really the most important component of strategy right now for people to think about is the way that real estate is being financed. And that
Yeah.
has a lot more to do with survivability than anything the market will throw at you, because the market's always going to have its own narrative and you just live in it. But in order to survive it, you have to have the right capital. And for us, we've been kind of the conservative ones out there, because I've seen what happens when people are over leveraged. I bought about 700 properties, single family homes from 2007 through 2013, out of foreclosure at the courthouse steps, because owners were over leveraged. They had more debt than their property was worth. And, for a multifamily operator, you would think, oh, that would never happen to them. But it does. I mean, over the course of the last 3 years, I would say the majority of multifamily transactions I've seen in the market are being traded with buyers who are getting high leverage, short-term bridge debt, oftentimes with preferred equity behind the bridge debt. And that's just the wrong capital stack. We're coming in with about 40% cash and 60% leverage from the agencies, and that on long-term 10-year debt. So that gives us the ability to kind of ride out whatever storm, and not have to worry about a maturity risk, and we don't have to worry about being over levered. And really, if you can come in with reasonable debt, you can survive whatever the market throws.
Yeah. The reasonable debt part is the biggie, because that cash injection that you've got there, that can fluctuate. It's okay for that to fluctuate, but every day that note is gaining, it is the interest is ticking up on that, and the serviceability could potentially change. But if you paid down quite a bit, because when you start, what's always worried me is these big fluctuations. It's not so much the little bumps as you go along, but then all of a sudden it's when the economy throws up like it did in '07. I mean, not it wasn't like, I think people weren't expecting like somewhat of a little bump to be like, ooh, whoa, here we go, and then but like it just went like people were losing. I mean, on a grand, people were losing 20-30% of the value of their house in literally, I mean, like a couple of weeks. I mean, it was just unbelievable.
Yeah, it was crazy. I remember that as an exercise, just to satisfy my own curiosity, uh, on a lot of houses that we bought out of foreclosure during that time, I went back in their history to look at previous sale prices of that very same property and compare those sale prices to the price we just paid. And this was 2009, 10, 11.
Mm-hmm.
And I could look in a property's history and find a sale from 1982, and there were times where I paid less than that 1982 price.
Hi, this is Casey Brown, host of the Cash Flow Pro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making Cash Flow Pro part of your day. Now, back to the show.
So I literally turned the clock back 30 years.
Yeah, and then from just say 2011 through today, you've made up 30 years in 10 plus. You've made up just call it 50 years.
Yeah.
I mean, if you made back the 30 in the first 5, now you've made 20 more since then.
Yep.
And again, I'm always kind of intrigued at the the ability to quantify time and money, like, and that's really a really good exercise to do, just to go back and say, hey, where did we fall back to, and then where are we headed, and that also gives you a little pause to say, hey, if we've made a 50-year fluctuation in 10, man, I hope the next fall off isn't bigger than the last one. I mean, but who knows, man? I don't think it's going to be. I think the cost of goods is going to stay up, and the cost of food and everything is kind of, it's kind of risen to levels where I think everything's going to kind of about stay like it is. So.
Yeah, I also think that the fundamentals of the real estate market in general are it's a different scenario than what we saw in 07, 08, 9, 10. Then the financing back then was just horrendous. And people, not only did they have too much debt, but they didn't even qualify for the debt that they had. And it was a recipe for disaster from the get-go. I mean, I remember going to foreclosure auctions in 05, 06, right at the peak of the market, and we're watching some of this stuff go to auction, and a couple other bidders, we're having a conversation, and our kind of collective opinion was, these prices are A, ridiculous, and B, it's not going to be long before soon there's going to be so much real estate to buy, but nobody's going to even want it. And
That's
lo
right.
and behold, fast forward about 2.5 years from when we were making that comment, and it was 100% true. I mean, there was houses being sold. There were for sale signs every third house on a street, and no takers. And that's what happened. Now, I don't think you're going to see that again, at least not.
No, and I'll tell you, one contributing factor I think that a lot of people forget is that we were at war. We were at 2 wars, really. Which I don't care how big or small a war is, but when your attention and your resources are diverted off of where they typically go, man, there's kind of no in between there. And I think that a lot of people, and again, that just is what it is. You can't, the financial backbone of everything, it puts everything kind of in limbo, I guess. So, but when you talk about buying these single families and doing all that stuff back then, what was the geography like? Were you pretty well staying in one area, or were you branched out over many states, or what did that look like?
No, we were in 13 counties in the San Francisco Bay Area.
Okay.
North San Francisco Bay Area, Sacramento, Northern California.
Sure. And I've often said, man, if you either do California or you don't when it comes to investing. I mean, it's because it's hard you almost have to immerse yourself in the laws, the regulations, the idea of California in general. You have to be immersed in all of that in order to make sure that you don't get snipped in the rear end.
Yeah. And I used to only do California, and now I don't do it at all. So it's,
I've had several people on this podcast that live in California, and they're like, nope, I'm out.
I'm one of them. Yeah. You can add one more to your list. I live in California, but I don't invest here. And we did, this was our primary stomping ground for 20 years. But I'm done.
Yeah. And New York is a lot the same way. It's not necessarily good or bad, but you need to be there in order to, and the people that have the strongest lobby arms seem to get the most, be the people that come out ahead a lot of times in those areas. I mean, it's the little nuanced laws that they can really capitalize on really quick. And so, but anyway, listen, Brian, I want to thank you for being on the show today. It's been, it's always a pleasure to talk to somebody that really has a deep knowledge of where we've been and hopefully some insight into where we're going. So I've got a couple of questions for you that we ask every guest that comes on the show. They're very simple. There's no right or wrong answer, but what is the best book that you have either recently read or are currently reading?
Can I count the one I just wrote?
Sure.
No, I can't count that one.
Let's give it a plug. Let's go the other route. What's the best book? And then let's give your book a plug.
So I think, I read a book recently called TED Talks, and it was, or TED. It was written by the guy that's in charge of TED.
TEDx.
Yeah, it's in charge of TED Talks, and it was a really interesting book because it talks about public speaking and delivery of your message. And in this business where we're raising capital from investors and buying real estate, your ability to convey a message is very important. I thought that was a really interesting book that you don't think of as a real estate book, but it certainly is a great business book, in my opinion.
Sure. Yeah. And the conveyance of messages is so important. And that's why I think a lot of people get so torn up over social media, is because, especially the written social media is they lose all forms of context. And text messages the same way. You can use the emojis and make those work some, but ultimately at the end of the day, context means a lot. But no, that's great. That's interesting. It's the first time I've heard that book. All right. What is a dream vacation that you either hope to take or have taken?
Well, Maui is my second home, so it's a dream vacation that I get to live about 25% of the year. And so now, whenever I think about going to a beach destination, I'm always comparing it to my own backyard.
It to Maui.
And and it's like, well, that wasn't as good. Why did I even bother? So, certainly I would say Maui is certainly it. But I've never been to Europe, and in August I'm going to London and Paris, so I'm really looking forward to that. So that's
awesome.
Gonna be exciting.
Yeah, Europe is definitely a sight to be seen. It's all of it. It's intriguing. So
I'm looking forward to it.
So, well, awesome. Well, listen, if the listeners have heard something that jumped out at them and something they may want to connect with you on, or a way to reach out to you, something like that, what is the best way for them to do that?
Well, there's a couple of ways. First, they can go to our company website for Praxis Capital. It's praxcap.com. It's praxcap.com. They can also go to Instagram at Investor Brian Burke. They can find me on the forums at biggerpockets.com, answering questions on the real estate forums. And if they want to basically know everything that's in my brain, they can check out my book, The Hands-Off Investor. It's an insider's guide to investing in passive real estate syndications. It's written for the passive investor who wants to learn how to properly find and vet syndication investment opportunities. And they can check that out at biggerpockets.com/syndication book, or available on Amazon or bookstores everywhere if you can find a bookstore that's still open.
Awesome, man. Listen, it's been a pleasure. Again, I'm always intrigued at listening to folks that know where we came from, and hopefully, like I said, have some insight into where we're going. So thank you so much, Brian. I know you're a busy man, and I want to thank you again for being on the show today.
It was a pleasure to be here. Thanks for inviting me.
Yes, sir. And listeners, as always, please head down and give us a subscribe. Click on the subscribe button for us, and also leave us a 5-star review if you liked what you've heard today. And I want to thank everybody for your time. Have a good one. Cashflow Pro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.